I found three excellent Canadian dividend ETFs with yields from 3.6% to 5.1% that could start paying you monthly income immediately and are ideal for those of you who are about 10 years away from retirement. First up is XEI, the Diversified Foundation. XEI is the iShares S&P TSX Composite High Dividend Index ETF. Think of this as the most well-rounded choice. It's like getting a balanced meal instead of just the main course. XEI charges just 0.22% per year and owns 78 of Canada's dividend powerhouses like Enbridge, Royal Bank, and TD Bank. These companies have been paying dividends longer than most of us have been alive. XEI currently pays about 5.1 annually, distributed monthly. What makes XEI special is its diversification. While it's still heavy on financials and energy, like all Canadian dividend ETFs, it has better sector balance with 14% in utilities, 10% in communications. So if you were to invest $70,000 here, you generate about $3,570 per year or $298 monthly. And really quick, I've noticed over 80% of people watching haven't subscribed. An easy way to help this channel for free is hitting that subscribe button, and I promise to keep making helpful videos like this. Now, your second option is ZDV, the Monthly Income Specialist. ZDV is the BMO Canadian Dividend ETF and is designed specifically for people who want reliable monthly cash flow without any drama. ZDV holds 55 top Canadian dividend stocks and pays monthly at 3.56%. It costs 0.39% annually. It's higher than the others, but still reasonable. What's unique about ZDV is its rule-based methodology that focuses on sustainable dividend companies with demonstrated consistent dividend growth. The lower yield means less immediate income, but potentially more stability. So if you were to invest $70,000 here, you generate about $2,492 per year or $207 monthly. This is perfect if you want steady cash flow without keeping you up at night worrying about volatility. Now, your third option is VDY, the low-cost powerhouse. VDY is the Vanguard FTSE Canadian High Dividend Yield Index ETF, and if you're a fan of Vanguard's ultra-low-cost philosophy, this is your pick. VDY owns 60 of Canada's highest yielding dividend stocks with an incredibly low 0.22% expense ratio, matching XEI for the lowest rate. It currently yields around 4.41% annually and focuses on companies with strong dividend sustainability. Now, here's a trade-off. VDY is the most concentrated. It has about 58% in financials alone. That means more risk if Canadian banks have a bad year, but also more upside if they perform well. So if you were to invest $70,000 here, you generate around $3,087 per year or $257 monthly. So which one should you choose? All three of these ETFs own essentially the same core companies: TD Bank, Royal Bank, Enbridge, Canadian National Railway, Bank of Montreal, CIBC, Bank of Nova Scotia, TC Energy, and Canadian Natural Resources. They appear in the top holdings of all three funds. They're all heavily concentrated in the same sectors too. Financials make up 30 to 58% of each fund. Energy accounts for about 19 to 30%, and utilities round out the rest. You're essentially buying the same 15 to 20 blue chip Canadian dividend stocks three different ways. So here are your three strategies. Strategy one, pick your favorite. Choose the one that fits your preferences. XEI if you want the most diversification and highest yield, ZDV if you prioritize stability and don't mind paying slightly higher fees, or VDY if you love Vanguard and want maximum exposure to Canadian banks. Strategy two is split between two, maybe 60% in XEI for diversification and 40% in VDY for low costs, or 70% in XEI and 30% in ZDV for different methodologies. Strategy three, equal weight in all three, about 33% if you want slight diversification, fund managers, and minor differences in weighing methodology. But honestly, you get 90% of the same result no matter which approach you choose because these three funds are just so similar. This strategy is perfect if you're within 10 years of retirement and want to start generating meaningful income from Canadian markets. It's great for anyone who needs cash flow right now rather than waiting for long-term growth, especially the tax advantages of Canadian dividend tax credits. But if you're under 35 with decades until retirement, you're probably better off with broad market growth ETFs like VFV or XEQT. These dividend strategies trade some upside potential for immediate income And if you can't handle seeing your account value swing up and down, dividend stocks will be much more stable than growth stocks, but they still move with the market. So here's how to actually implement this. First, start smaller than you think. Don't put $70,000 on day one. Start with $5,000 to get comfortable with the monthly payments and price movements. Then gradually build up. Second, set up automatic dividend reinvestment with your Canadian broker. Most brokers like Questrade, TD Direct Investing, and RBC Direct offer this for free, and it automatically buys more shares with your monthly payments. Third, if you choose multiple ETFs, rebalance once per year. If one has grown much larger than your target allocation, trim it back and add to the others. This forces you to sell high and buy low automatically. And if you want to calculate your exact returns with your investment amount, check out my free investment profit calculator in the description or first pinned comment. Bottom line is these Canadian dividend ETFs can generate serious monthly income while providing preferential tax treatment. But they're not magic. You're trading potential growth for immediate cash flow, and you need to understand exactly what you're buying. Whether you choose one ETF or a mix and match, this approach works incredibly well for Canadian investors at the right stage of their wealth journey. Those who want to transition from pure growth to income generation while taking advantage of Canada's dividend tax credit system. The key is picking the approach that matches your preferences and sticking with it consistently over time. All right, watch these two videos for more investing tips.